It's all about the numbers, or it's nothing to do with maths. Which is it? Some people will say property investment is about the numbers and the maths, and there is countless formulas out there, and there's a whole host of YouTube videos from the 4% rule to the 1% rule. And then there's other people who will say that it's all about experience and instinct. The truth is, it's a bit of both. You need to blend experience, a bit of your gut with the numbers to really find a good deal. But how do you start off in property investment if you don't have any experience, or you haven't built up your instinct and you don't know how to run the numbers? In this video, I'm going to try to help you answer that question. I'm going to break this video into two parts. First, building your experience, getting your gut, understanding what your instincts are in terms of buying a property. Secondly, I'm going to explain the numbers a little bit. And then as a bonus, I'm going to give you 4 characteristics that I look for in any real estate deal when I'm working with investors, working out their long-term strategies. I recently got asked to make a video on the type of properties that I would recommend buying, following a video that I made about 3 properties that I would avoid buying. In this video, I'm not going to focus on any one particular property type or market, because everyone's strategy is going to be a little bit different, and my strategy could be totally different. In this video, I'm going to help you kind of lay the foundations so you can build a successful strategy for investing in real estate. So how do you gain the insight and the confidence to invest in real estate if you've never invested in real estate before? Well, first off, you need a good why. Real estate is about the long term, and if you don't have a good why, you're not going to be able to stick at it long term to make it worthwhile. The next important factor to have or to determine is your criteria, and this is a step I wouldn't skip at all. And by criteria, what I mean is a type of property and type of investment you're going to go after. Someone's criteria could vastly range from the next person's. Some people could be value add or distressed properties, or a £50 million plus office block, or 100 plus hotel room or development sites near public transport, or sites for social housing, or it could be a retail unit near public transport, or 1-bedroom apartments in the city centre, or 3-bedroom homes near colleges. Or it could be looking to buy below the average asking price or below average sales price for a particular area, or buying properties that are valued less than their replacement costs. So there's a whole host of criteria that people can apply. And criteria can become even more detailed, i.e. it must have car parking, it must be less than 500 meters from the nearest bus stop, it must be built before 2000 or built after 2010. Everyone's criteria will slightly differ, but it needs, or your criteria needs to be definable. You don't just walk into a jewelry store with the plan that you're going to ask your girlfriend to marry you, and the only criteria that you have is a budget of 10k. You might walk out of there with a Rolex. She may say yes, but you're still going to end up having to buy that ring at some stage as well. My point is, the very best property investors have a very clear, defined criteria on the properties that they may consider buying. Part of your job as a property investor is to define your criteria on types of properties that you think will do well into the future. I get emails from investors all the time, blah, 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 saying, hi, I'm interested in investing in Ireland and I have a budget of 10 million. Can you help? Generally speaking, I will just hit delete on that or not respond. But sometimes I will get emails that say, hi Shane, I'm looking for a commercial investment property in Dublin city centre, perhaps Dublin 2, with secure rental income, stable tenant, future rental growth. I'm seeking a gross yield of perhaps 6% or above. Our target lot size is 5 to 10 million, ideally retail, with some additional uses. Our solicitor is Joe Bloggs. Here's some additional detail. When these type of emails come through with clear defined criteria, they're the kind of people, or they're the kind of emails I might save in case something comes up down the line, or in case I can help them further down the line if something else does come up. My point is, having a clear defined criteria opens doors, and it can be as simple as when you're looking for a 1-bed apartment, i.e., hi, I'm looking to buy an investment property, perhaps in Waterford City. Ideally a 1-bed apartment. The apartment should be near to the water with good transport links, car parking, no rental cap, a low enough service charge, and I am hoping to buy with cash and remortgage later. and I'm ready to do a deal quite quickly. So if you got an email like that, perhaps an agent will respond to that and save your details, and they may be able to work with you into the future as well. Again, having a clear defined criteria from the start opens more doors. If you are a regular viewer of this channel, or you've seen me talk on other things before about this topic, about starting into real estate, I believe one of the most important things you can do as an early investor is to grow your network, or build your network and build your team. You don't have to have all the experience in the world if you have a good team that has your back. Build a team of agents, solicitors, accountants, contractors. All these will help you into the future, and they will work with you, and you can gain from their experience as well. But as I said, the first thing you should do after you have your why is set your criteria. And remember, don't skip over this part, because it's very important. It's like your elevator pitch. You need to perfect it. As you network with agents, solicitors, etc., you will be very surprised what's offered back to you if you have a well-defined criteria. Bonus is, once you complete one deal with these people, they will feed you more and more deals as well. Whether you're a big or small investor, your network needs to know what your criteria is, because when they do, they'll be out there doing the work for you and doing some of the hard lifting for you, finding some of those good deals. Let's say BlackRock has $1 billion to spend on single family homes in a particular area. You can be damn sure that they're letting as many people know as possible, and as many people who will listen to them, exactly what they want to buy and where they want to deploy their funds, because they understand that their network is important for them to actually go out and find those deals as well. You may ask, what's the point in gaining all this experience and insight if you don't know how to stack the numbers up? Well, perhaps you don't need to know how to stack the numbers up anymore. AI will be looking after that for you next year, so what's the point? That may be a slightly throwaway comment, but I do believe it's probably going to be the reality quite soon. AI will be able to answer most of these number questions quite soon if they can't answer them already. But you can, if you want, make the maths side of this as complex as you want, from detailed development appraisals for sites, or discounted cash flow calculations for investment properties, or you can make it as simple as you want with the 1% or 4% rule. Again, many of these rules I've only seen on YouTube and never in any textbook. But most property investments boil down to the yield, or the cap rate as they call it in the US. Valuers can layer complex yield calculations onto this to allow for, or to account for, void periods, rent reviews, break options, and a whole host of other factors. But in the majority of cases, the initial gross or net yield will tell you if the property is worth reviewing in more detail and carrying out further due diligence. To get the gross yield, you need to divide the price of the property by the annual rent and divide that by 100. For example, let's say a property is being advertised for 5 million with a rent of say 250,000. 5 million divided by 250,000 in terms of the rent is 20 times the rent. Divide that again by 100, i.e. 20 by 100, you'll get a yield of 5%, or a cap rate of 5%, and that is your return on your investment. Let's say they don't have an asking price on the property, or you want to know what's a good bid to put in on this particular type of property. If you know the rent is 250,000 and you're not sure what the value should be, but you know that similar properties, similar type properties in that area sell for generally a gross yield of about 6%. You divide 100 by 6, which equates to like 16.66. You multiply that by the rent of 250,000, which will give you a value of about 4.16 million. And then you have to kind of allow for acquisition costs within that as well. So they are the most basic yield calculations out there. You can add layers of complexity to them if you wish. However, knowing how the yield is calculated is irrelevant if you haven't set good criteria. Hence why experience and insight is sometimes more important. Anyone can run the numbers, and as I said, I think AI will be doing it for everyone next year. So setting clear criteria and terms as well will define your success as a property investor. There's no real point telling me that a 7% yield is a good investment for a property. That might be a great investment yield for a prime apartment in Dublin, perhaps in Ballsbridge, or an office block in the capital with a strong tenant sitting there on a 25-year lease. Most people bite your hand off for those yields, but it would be a shockingly bad yield for a high street retail unit in Tullamore. And that's the crux of it, or the point. There's no point actually setting or determining your required or desired yield for a property if you haven't actually set the criteria. The yield equates to risk. An apartment in Dublin is less risky than a retail box in Tullamore. An investor looking at a prime office block in Dublin might be happy with 5%, might be delighted with 5%, or someone looking to buy an apartment block in Ballsbridge might be really, really happy with 4%. But an investor looking at retail units or small regional towns may only be happy if they get a 10% or higher yield. The markets will determine the yields, but you get to set your own criteria, and you also get to set your own terms. And when you find a deal that matches your criteria and terms, you know that that is something you should look at, and that's what makes a good investor. Once you've set your criteria and you have an idea what a good yield will be for your required property, you can then start to set your terms. And your terms will include everything from your budget to your loan to value ratios to your cash flow requirements and your required yield for that type of property. So your criteria is the type of property that you are looking for that fits in with your strategy. When your terms and criteria match up, you know you may be able to do a deal on that property. Be open to your network with your criteria, but you can keep some of your terms to yourself. Your terms can also be a good indicator on when to sell a property. If the yield on a property is something that you wouldn't pay for it, perhaps it is worth considering selling. And it is important to be aware of this, because this is how some people look like they time the market. When I'm working with big or small investors and we're reviewing long-term strategies, I always try to look for these 4 things within a deal. 1, can we improve the market value of that property quickly using our own experience and network better than the market can achieve itself? I.e., can we improve the lease structures? Can we do refurb or redevelopment of the property? Can we agree pre-leases with commercial tenants that we're aware that are in the market? Can we split the property up for greater value, or can we combine it with another portfolio to attract a larger type of investors? 2, can we improve the rental income of that property over the next few years, and what is our clear defined strategy to achieve a higher rental income? 3, is there an alternative use for the property if tenant demand for one sector starts to weaken? Is it possible to convert the property into a more valuable use in the future if one sector starts to weaken or underperform? And 4, and perhaps most importantly, will there be investor demand for this type of property in 10 years' time? And will it be sellable? Will the yield move in a favorable way? Or will investor demand weaken for that property type in the future? And these are all important things to consider, i.e., will future technology make this property null and void, or demand for this property null and void in 10 or 20 years' time? And this is a very important factor to consider when buying a property, because it is about the long term. These are just some of the criteria I look for when reviewing strategies. Everyone will have slightly different viewpoints on it, but all 4 of these can be applied to any property. Hopefully you did get something from this video. Please do us a huge favor and hit that like button. It helps me out massively. Also subscribe to the channel if you haven't done so already. As always, I'm Shane Fleming, and thanks for watching.